This is Seth David with schoolofbookkeeping.com, bringing to you a very special screencast. This time we're talking about how to record a loan from a friend to your business. So, we got a question, and if you want your question featured in a video, just say so. This person actually didn't ask, so I'm excluding the contact information. I suppose I can go on a first name basis. At least Gail, who's one of our students at schoolofbookkeeping.com, wrote in and asked me this question. She said, here's a puzzle for you. Todd gives a friend $10,000 cash out of his saved personal funds. Now, I think we've got this actually flipped on that first sentence, and you'll see why. And when I responded to her via email, I made that point. She says, the person wrote 2 checks, each for $5,000 to ITS, I assume that's the name of the company, not Todd, and Todd deposited them as follows. So I think the first thing is flipped. I think what happened is Todd's friend gave him $10,000 cash out of that person's personal funds. So assuming that I'm right in how I'm interpreting this question, the question then follows. $5,000 went into one business checking account and then wrote a check from that bank account to transfer that $5,000 to another business checking account. Then the other $5,000 was deposited into the other business checking account. So in essence, the business got $10,000 with nothing to offset it in QuickBooks. That is money owed to Todd, the owner, and eventually he will get it out. But I need debits and credits to specifically to that account that let me end up with ITS owing Todd the money. Someone I think I've tried everything. Shareholder loans, pass-through income, and nothing balances. Can you spell it out for me? Debit this, credit that. And I definitely can. I can definitely do that for you. And not only did I do that in the form of an email, but I'm doing it in the form of a video response. So the simple answer is, if you trace through the money, what's really happening here, let's assume a friend loaned Todd the money, and then Todd in turn loaned the money to the business. That's what's really going on here. So in effect, as far as the business is concerned, Todd loaned the money to the business. Very simple. So here's what we have. We have 2 checking accounts, and this is a sample QuickBooks file. So we have iBank, and then let's create another bank account because we have 2 checking accounts for the business, right? And we'll call it a bank account, and we'll call it B-Bank. iBank and B-Bank. Now, what's really happening, as I said, is let's forget about the fact that the money ultimately came from Todd's friend. Todd loans money to the business. So in the first instance, we have a deposit, right? So we go banking, make deposits, and the money comes in, and it is a loan from Todd, right? So due to Todd. It's a liability. We'll set that up, and we'll say other current liability, right? Continue. $5,000, but first we have to finish saving the account. I wish QuickBooks was smart enough to know which screen I'm on. Now, 5000, right? $5,000. Let's run a balance sheet. I always like to look at a balance sheet when I'm doing this kind of stuff, so I can see what's going on. So we're about to add $5,000 into iBank. Okay, so that's part one. Part one, Todd got. I don't care that Todd got it from his friend. We'll deal with that at the end. But right now, Todd's loaning the money $5,000. Simple, 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 simple. So there's my due to Todd, and I went into B-Bank with it. No, we wanted to go into iBank with it. So let's go back and fix that. Did not pay attention to the bank account. Very bad bookkeeping on my part. I'm a bad bookkeeper, a big bad bookkeeper. Yes, I want to record my changes. So I have now $505,000 in the bank, $5,000 due to Todd. Now, the next part, she says that he wrote a check from that bank account to transfer that $5,000 to our other business checking account. So that's easy. Banking, transfer funds. And we transfer from iBank to B-Bank. That's $5,000. Save and close. Refresh the balance sheet. Now I have $500,000, which is what I originally had in iBank, and I moved the other $5,000 over to B-Bank. Now, if this was a separate business, if it was a different business that we transferred the $5,000 to, then that would in turn become a loan from this business to the other business. So we would have an asset now. We'd still have the due to Todd. But from the question, it doesn't sound like that's really what's going on. She said to our other business account. So I assume that means our other business account, not our other business bank account. So you get the distinction. That's why sometimes it's hard to answer email questions, because you can't necessarily tell exactly what the implications are. So now we get another $5,000, she says, that went into the other business account. Well, that's easy. So banking, make deposits. That one's going right into B Bank. Also due to Todd, $5,000. So we're going to see B Bank go up to $10,000, and the due to Todd is going to go up to $10,000. Save and close. Sure enough, due to Todd is $10,000. B Bank now has $10,000 in it. Now, if we were keeping Todd's personal books, and this money, in fact, came from Todd's friend in cash, then on that books, we would have to do a journal entry. And quite simply, what we would say is we would, on the personal side, keep in mind, we would debit loan to the company, right, because the company now owes that money back to us. And we would credit a loan from a liability account, loan from our friend, right, whoever that is. So we're actually increasing an asset in the form of a loan that's owed back to us from the company, and increasing a liability in the form of money that's owed back to our friend who loaned it to us. So that's how you kind of deal with the fact that the friend loaned me the money personally, and then I in turn loan the money to my business. Each thing is separate. That keeps the accounting simple. Treat it separately. The inclination might be to want to treat it as a loan from a friend to the company. And you could do it that way, but that's not really right, and it's not clean, right? We don't want to sort of involve the personal loan in with the business. The friend made a personal loan to a friend, and then that friend who owns a business made a loan to his or her own business. That's really the substance of what happened here. As always, if you have any questions, please reach out to me. You know how to reach me. It's Seth@schoolofbookkeeping.com. Or you can call me at 866-945-8070, or just visit us at schoolofbookkeeping.com and subscribe already. There's so much good stuff in there. Just released, as of the time I'm recording this, 6 new lessons on our Mastering Excel for Accounting Pros course. And I'm teaching you how to do things like write formulas, but in the context of what it looks like on things like sales data, or how to take a customer list out of QuickBooks and combine it with sales data so that you can do some really cool stuff with that information and analyze it in several different ways. So get on with it already. Go to schoolofbookkeeping.com if you haven't already, and subscribe and send me your questions to Seth@schoolofbookkeeping.com. And if you want to be featured in a video, just indicate that you would like it to be featured in a video, and let me know what I have permission to say about you as far as your contact information. As always, I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.